Yesterday, US inflation data came in line with expectations for February, yet the benign data failed to calm markets as oil prices surged despite the IEA's announcement that it would release a record 400 million barrels from its strategic reserves. The fresh attacks in the Middle East weighed heavier and continue to weigh heavier this morning again. And rising energy costs across the globe are strengthening the US dollar and pressuring energy importing currencies such as the euro and the Japanese yen, and increasing the downside risk for global equity markets as well, with no easy relief in sight. So welcome to Swissquote's Daily Market Talk. It's Thursday, the 12th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So yes, US inflation yesterday came in line with expectations for the month of February. Headline inflation steadied near the 2.4% level on a yearly basis, core inflation near 2.5%, yet the tame numbers couldn't cheer up investors as oil prices rose, and they rose despite the news that the IEA would release a record amount from its strategic oil reserves to keep oil prices in check as the Middle East war continues with no near-term end in sight. So this felt like a typical buy the rumor, sell the facts price action. Oil prices eased earlier this week on news that the IEA would release reserves and rebounded after the announcement that they would release 400 million barrels. Now the funny thing is, I call it funny, but it's not really funny, the IEA announcement was actually near the top end of expectations, so it could have really given some relief to the market. But as it was the case during the release in the early days of the Ukrainian war, the news fueled oil prices instead. Some actually said that the size of the release rather increased worries that this war in Iran would last longer than many thought. And again, the math is quite simple. 400 million barrels would just be enough to meet the IEA's consumption needs for the next 9 to 10 days, given that the demand from the IEA countries is about 45 million barrels per day. And after, well, the IEA is estimated to have around 1.2 billion barrels of oil in its reserves, so it goes quite fast. Its head Fatih Birol indeed said that only the resumption of trade in the Strait of Hormuz would help. And well, that's not on the menu du jour. So oil spikes higher again this morning with US crude up by more than 6% at the time I'm talking here, above the $94 per barrel level, while Brent is up by 7% and is trading near $97 per barrel level on news that 3 more vessels were struck in the Gulf yesterday. In summary, oil will hardly return to levels that would tame inflation expectations around the world until tensions in the Middle East materially ease. And while rising oil prices lead to a significant shift in central bank expectations, the US 2-year yield, for example, that best captures the Federal Reserve rate expectations, approached the 3.70% level this morning in Asia. That's the highest level since September last year, as a benchmark for the European 10-year yield spiked to past 2.5-year highs near 2.95% level. In the FX, the US dollar is up again this morning, extended its gains against most majors. But the Middle East war and rising oil prices hit majors unevenly. The so-called oil currencies, that includes Australian dollar and Canadian dollar, for example, outperformed the rest since the war burst almost 2 weeks ago, while the oil-dependent yen and the euro were among the hardest hit among the majors. The dollar yen, for example, is preparing to test the 160 psychological mark this morning that could eventually trigger intervention from authorities, while some ECB officials warned that they're not willing to make the same mistake as they made during the Ukrainian energy crisis, meaning that, well, they could act sooner rather than later in terms of rates in Europe to prevent inflation in Europe from rising on energy prices again. But that comes with the threat of slowing growth in the euro area and is not necessarily positive for the euro. So the euro dollar could retreat down to 113.50 level without compromising its longer-term bullish trend that has been building since the beginning of 2025, since Donald Trump's return to the White House. But below that level, the single currency will return to the bearish consolidation zone against the greenback, and rising oil and energy prices and its energy-dependent status would be to blame. And what's certain is that a second energy crisis in just 5 years highlights the urgent need to wean the European economies of imported energy. So the clean energy funds are rising in value along with oil and gas prices these days, while gains in uranium remains relatively weak, I think, which is surprising to me, as the Europeans this week said in a summit that abandoning nuclear was a strategic mistake of the past and that the continent is ready to get back to the nuclear. It's indeed the only way for the Europeans to gain their energy independence and peace of mind in this crazy world, as wind and solar cannot provide enough energy to satisfy demand. Even in technology weak Europe, yes. And traditional energy space, the energy companies gained 2.5% in the US yesterday, while the S&P 500 was flat to slightly negative. Mega gains across big technology companies helped limiting losses yesterday on the index level, as Oracle, for example, jumped 9% after announcing strong quarterly results and better than expected guidance as well, while telling its investors that the customers of the company would be paying upfront for the expensive chips themselves, preventing Oracle from taking on more debt. It was a very unusual move for a company, but it actually helped pour some water on leverage investment worries and help Oracle gain after the results. But elsewhere, the private credit stress has only gotten worse this week, on multiple news on the wire regarding banks, for example, writing down the value of their loans to these companies. Those who have exposure to software companies are particularly concerned. So overall, I don't want to sound pessimistic, but there is a combo of ugly news and headlines right now that suggests that the market risks remain mainly tilted toward the downside. We have AI anxiety. We have severe disruption to oil and fertilizer trade. That leads to a very big threat to global inflation levels. And we have private credit stress. And yet many Western indices are still near their all-time high levels. So I think a 10% retreat on the index level for US indices, for example, looks plausible to me. And given the cyclical and energy-dependent nature of European companies and the European Central Bank's cautious stance, we could see deeper sell-off across the European indices, in my opinion. The Stoxx 600 has lost 8% already at the worst of this week's sell-off, and the recovery in all indices remains fragile and contingent on the war headlines. And the war headlines are not necessarily beautiful right now. Now, one place that outperforms its global peers is China. Yes, the Chinese CSI 300 index lost less than its global peers since the war started, mostly thanks to China's diversified energy supplies. And the fact that Russia is now rubbing its hands due to the Middle East oil disruptions and US relaxing its tone against buying Russian oil certainly helps. But if the war pushes global economies into contraction, with China, which exported record amount last year to global economies, would also find itself in a difficult position, I would say, because inside China, the country is still dealing with poverty and a deep demographic crisis, meaning that China could hardly do well when its clients do poorly. So in summary, there is nowhere to hide safely, really. The war headlines and energy prices will continue to determine how risk appetite across the globe will evolve in the coming days. And I would like to note that it's nearly impossible to give any prediction on where the oil prices will be going from here. On the contrary, I take oil and energy prices these days as given, as war headlines. The higher they go and the longer they stay there, the shorter the market rebounds and the bigger the risk of a notable global financial meltdown. So it remains a hope that the tensions will ease very soon. This is all for today, guys. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.